Morning folks, Wednesday 12th, thanks for joining me. Right, Aussie CAD is what I've got on my screen at the moment. I talked about Aussie CAD having some support here and got quite excited about that when we got the bullish engulfing candle there. Let me see now, that was Friday. So I thought that that was playing out the way I had expected it would, but it now is not. Unfortunately, some of these markets having seen some breakouts, and I got quite excited about them, thinking that finally we'd have some directional movement, directional other than sideways, but that actually isn't the case. So as you can see, we've got that red green pattern here in the daily chart, literally down one day and up the next. So we just can't do anything with that Aussie CAD, I'm afraid. So that trade idea is pretty much done. Just wanted to notify you, we can't really do much with the market that's going up one day down the next at the moment. Okay, so we've got Aussie yen now. Aussie yen did break higher, and then we got this surprising negative candle here where we spiked higher and we had a small red body kind of shooting star. I haven't given up hope for this one. I think the Aussie yen can still go higher. I'm hoping this is just a little bit of a correction back to the trend line. I talked about that yesterday. We've dipped a little bit further today. We've got down as far as 84.72. As long as we hold above 84.40, I'm confident that Aussie can continue higher against the yen. So I haven't given up. I still see this as a consolidation pattern in a bull trend. And let me scale that. This is the daily chart. You can see we're in a big bull trend. This is probably a flag, and this is probably going to go higher eventually. There's nothing telling me that the market has topped out, put it that way. So I'm still optimistic. I'm just a little bit surprised at how we haven't taken off after the breakout. I could suggest probably that that's a bull flag and that we've just come down to retest that upper trend line of the bull flag, and hopefully we'll take off from here. As I say, a bit disappointing so far, but maybe that's just a really excellent buying opportunity. Maybe we were actually witnessing the low of the pullback before the market takes off. Aussie dollar, similar situation as the Aussie yen, the Aussie easing back a bit. Again, I haven't given up hope on this. We still have some support around, where have we got it now? Let's just go to the daily chart. Sorry, the 4-hour chart is where I want to go to. Right, let's blow this up. We've really got to hold. Let's put some fibs on here. Okay, we've dipped below 7,800, so that's a bit of a risk. We could get down to 77.60, 77.50. That really has to hold. If the bulls are going to keep control of this market, then this really has to hold. As you can see, we've got the 100 period moving average on the 4-hour chart. Let me put some crosshairs on here. Coming in at 77, let's call it 77.65. We've got the 38.2% fib around 77.55. That has to be the support level of the day, and that really must hold. I'm just going to flick to the 1-hour chart just to make sure I haven't missed anything, but I don't think I'll see anything of particular importance on it. So the 500-hour moving average coming in around the same area as the 100 period moving average on the 4-hour chart, which mathematically sounds about right, doesn't it? So okay, so there we go. That's my view for the Aussie. As long as we can hold 77.65, 77.55, bulls are in control. Bit disappointed with this at the moment. Still trading mostly sideways. I mean, well, you can see we have actually managed to climb throughout April, but wow, difficult to hold a long position. We are literally up one day, down the next. Still here, even though the down days were bigger than the up days. And then I thought, here we go, we've broken, ready to rock. Not really, but as I say, hopefully we will eventually get some momentum to the upside. Okay, Canadian dollar versus Japanese yen is holding up a little bit better than the Aussie dollar. On the daily chart, we have just a consolidation phase, really. We've broken up above a good trend line, so I was expecting us to move higher. Now we've unfortunately sideways again. Look, yesterday just a doji. We tried going up, we tried going down, we closed mostly unchanged to end up with a doji. That just indicates the indecision that is in the market. The bulls can't get control yesterday. The bears can't get control yesterday. So a little bit difficult, but I still think that we are in a bull trend, and I think that we can buy into dips. I'm wondering if the yen will weaken across the board. Actually, we'll see. Euro CAD, you know where we are with that. It's holding the trend. It's holding the support level. We need to see that on the weekly chart, but it's just not really doing anything. It's holding above the support level and not going anywhere. There we go. There it is, around the 4600 area. But when you go back to the daily chart, you'll see yet again this is another down, up, down pattern over the last 1, 2, 3, 4 sessions. So we'll just have to see what happens there. But literally, again, down one day and up the next. So we're waiting for a break. Euro yen. Euro yen. Where are we? Okay, so that's beaten some resistance. Was looking for that to rocket again, not going anywhere so far this week. Monday, a bit of a disappointment, spiked higher, little red body on the close, very similar price action yesterday, pushed up, closed unchanged on the day. So it's more of a consolidation so far this week. We'll see what happens with that, but again, you've got to stick with the bulls. We are in a bull trend. This is probably just a consolidation. Markets have absolutely loved a consolidation over the last couple of months. I would like to see a bit more of this sort of February price action where you get a nice big move to the upside, but right now it's a lot of consolidation. We've got CPI out today in the US. It's going to be an important number, inflation number. There's a lot of focus on inflation at the moment. I'm sure you've been reading the financial news. It seems to be a lot to do with this chip shortage, pushing up price of electronic goods, which are very much in demand, and the supply is being curtailed. Everything from cars to laptops to phones, everything. So it's been a real problem, and as we know, commodity prices have been going through the roof too. So there really is a lot of inflationary pressure out there, and that has been the main focus of this week, with stock markets plummeting actually yesterday. We'll have a look at that in a minute. But maybe the commodity currencies will eventually pick up: Aussie dollar, New Zealand dollar, and Canadian dollar. Right, euro. Okay, again, not much going on. I would like to be more exciting in my commentary today, but I can't do much when we have got this up, down pattern again in the euro. So more of a consolidation. Where are the levels that look important to me today? For me, I think we had the same level yesterday. The big one is around 120.75, 120.65. That looks like the big support level. A little bit of support just above 121.00, and we held that yesterday. We got down as low as 121.14. 121.07 is the first little fib support I've got there, but the big one for me is down here at 120.75, 120.65. We do have resistance overhead from this trend line, which I shall blow up to show you properly. Just to remind you, we looked at it yesterday. Decent trend line, goes all the way back to June of last year. So it's a pretty long-term trend line, and that comes in at 122.00, creeping up to sort of 122.10 maybe today. So if we rally about 70 pips odd, that will be the resistance. If we go down around 60 pips, then we've got some support. So at the moment, kind of no man's land and drifting sideways. New Zealand dollar, Japanese yen, again, bit disappointing. Had expected more from this. Nice breakout Monday. We were looking at that with Greg. But no follow through. We've dipped down again. It's a bit frustrating because this ascending triangle really did look promising. So we'll just have to see what happens if we dip down to the support level, which looks at around sort of 78.30, 78.20. We are in a bull trend, but it really is like a 2 steps forward, 1 step back style trend at the moment. New Zealand dollar, Kiwi dollar. Right, the big resistance level for the Kiwi dollar was around 73.00. That has worked really well this week. I think that's the exact high actually, 73.04. We're drifting down. Let's have a look at the short-term chart to see where we could get to. So the 4-hour chart is showing good support now. Good support. We are in a bull trend, and we have got good support down at 72.20, 72.10. Now, you can see we've already just bounced off there from 72.25. So we haven't quite got to 72.20, and already we're recovering. So just watch that level today, 72.20, 72.10. Break below 72.00 pretty much kills that. And then we will be down here at 71.70, 71.60, which is the 500 period moving average on the 4-hour chart. It's a 38.2% fib support level as well. So those two big levels there, 72.20, 72.10, 71.70, 71.60. They're the big support levels for the New Zealand dollar today against the US dollar. As I say, we are in a bull trend, but this is one big consolidation. Let me scale it. This is one big consolidation pattern. I don't think it's a head and shoulders pattern. You could call it a diamond top actually, but I think we're probably jumping the gun there a little bit. We'll have a look at that as it develops and see what we think. But diamond tops are quite rare, so if it is one, that would be interesting. We'll examine that maybe later in the week and see if it develops. I'll just show you how it would look. Let me just take that off. So you've got trend line going like that, trend line going like that, and that is after two trend lines that go like this. Oops, that's not what I'm looking for. Let me take that off. Oh, done it again, sorry. Let me just expand this so I can get the right point. There we go. Get my ray, get my peak. There we go. And then you have something along the lines of, I would say, a trend line going, yeah, something like this. Okay, that'll do. Right. When you put all that together, you have a diamond pattern. Can you see that? That is a diamond top, and actually it is looking increasingly like that. So what will be important if to watch in this, didn't spot that earlier, I've just spotted it now. Okay, so we will have support around 71.75, 71.65, as I said already. Now this is the daily chart I'm looking at. We've got the 100, let me get the crosshairs on there. We've got the 100-day moving average at 71.70, and we've got the 50-day moving average at 71.38. Okay, so if we break that support level I talked about, 71.75, 71.65, that could be a breakout of the diamond top pattern. It's something we're really going to have to watch there. We'll have a look at that tomorrow morning again, see if that breaks. That will be something to really investigate. That would be really interesting. That's very, very rare pattern, diamond top like that. You don't see them often. Okay. Dollar yen, well, the levels are just trading perfectly. We're not going anywhere particularly, but for scalpers, the yen has also been a great market. I've shown you the trend line. Going back here to, where is it now? January, I think. Yeah, beginning of January, wasn't it? Yeah, there we go. 5th of January. So, this trend line starts here at the 21st of January. So, nice trend line. Oops, I didn't mean to do that. There we go. Nice trend line going all the way back there. As you can see, held perfectly. In fact, we've even got a beautiful little long lower candle wick on this candle, just to show how keen the buyers were to jump in at that trend line. On both occasions, we had good buyers down here. And that I wouldn't call that a double bottom. If you're wondering, we just didn't have enough movement to the downside really for that to be a significant double bottom. But nevertheless, there are two lows there, bang on the trend line, and we're starting to recover now. Now this week we have not been able to get above 109.00. That's been my main resistance for the week for a number of reasons. You can see just on the what are we on here now? The 4-hour chart. We've got moving average resistance at 109.05 and 109.15. So that 109 area really is going to be key. Resistance, I think on the weekly chart is where we've got a big moving average line, if I'm not mistaken. Yeah, it's the 500 week moving average up here. Is it 500? No, it's not, it's 200. 200 week moving average up here at 108.90, 109.00. So there's a lot going on around 109.00. That's why it's the high for the week. It's absolutely key. We start getting above 109.20, and then we can talk about the dollar going significantly higher against the yen. So we'll watch that. Which one wins? Is it the moving averages, or is it the trend line? The what do we call it? That's a 4-month trend line, isn't it? Or the 4-month trend line. Which one wins out? Which one will the bulls benefit from the trend line, or will the bears keep the market under control if we hold below 109.00 and break below the trend line? We'll just have to wait for the price action to tell us, but be ready maybe to jump on that. Break above 109.20 should be pretty positive. Break below 108.30 should be pretty negative. In the meantime, that's a scalper's market, isn't it? There's a good 60 pips or so, 50, 60 pips, scalping those levels in between. Certainly would have worked so far this week. Gold, we are trapped in between the moving averages. We've got the 50-day, oh no, that's the weekly moving average. So we've got the 50-week moving average coming in at around 108.40. We've got the 200-day moving average coming in around 1850. So that's why 1840, 1850 has held the upside so far. Seen a little bit of a pullback, but buyers are coming into gold when the market dips. So yesterday we got down as far as 118.17, quite a significant fall to the downside. But look, buyers straight in, waiting. So, you know, there is support in gold. When we dip, there is support. The buyers are waiting on the sidelines. That was proved yesterday. What can I show you on the 4-hour chart? I can show you that if we get further down today, 108, sort of 108.10, 108.00, that looks like a really good support level. We've got 23.6% fib support. We've got the 50-period moving average coming in there as well on the 4-hour chart. I'm sure we've got moving average down there on the 1-hour chart as well, lending extra support to that weight. This is interesting. Now, this is why we bottomed here yesterday. Look at the 1-hour moving average, 100-hour moving average. And this is a good moving average, the 100-hour, especially for you scalpers out there who trade quite short term. The moving average was around 168, well, just above 118.16. The low was just below 1818. So again, moving average, 100-hour moving average comes in at around 1825 today. If we break that, then we should be headed for 1818 certainly, and we could be headed for 1810, 1800, and that would be a good support level. Here comes the 200-hour moving average moving up gently towards that support level as well. So those are good levels in gold today, I think, worth watching. And buying dips, I think, is the way to go. We are on a short-term bull trend. I think that bull trend will continue. It's just a real struggle to get any market with any momentum at the moment. Having said that, stock markets do have momentum. Now, I've talked about the double top in the Nasdaq for a while. I've talked about risks to the downside. Here we go. We have been heading lower. We got to the 50% fib yesterday and bounced, but really we're going to have trouble with these moving averages here. This is the 100-day moving average at around 13,300, 50-day moving average at around 13,400. So 13,300, 13,400 certainly looks like it will be a tough resistance level today as those moving averages converge. I'll be watching this daily chart for a moving average crossover. That would be more negative, certainly in the longer term, and it could happen. The Nasdaq seems to be getting hit harder than the other stock markets at the moment. It must be more interest rate sensitive, maybe more inflation sensitive, maybe struggling with that chip shortage. Now, here's what could happen over the next few days and weeks. I talked about this yesterday. I touched on it yesterday. We could maybe dip down to the 200-day moving average, which at the moment is around 12,500, bounce off that, maybe come back up to the 13,300 area and then form a right shoulder. And this could be a really interesting head and shoulders pattern that would lead to something more significant to the downside. We would be talking something in the region of 2,000 points on a break lower. Now, I'm jumping the gun here. We haven't even necessarily bottomed from the head yet. So the head's not even formed. But I'm just showing you what could happen because I'm looking at this shoulder here and the peak not much higher than the left shoulder. It makes me wonder whether this will form. But anyway, as I say, jumping the gun there. It's just something we'll watch develop over the next days and weeks. And if that does happen, that's going to give us a real nice trade. We had a wonderful trade in the Nasdaq back in February, March, I think, when it dropped significantly. So I'd like to see something like that happen again. It gives a real strong signal. But for now, the Nasdaq definitely in a short-term bear trend, seeing a significant correction after that double top, becoming more volatile. This is quite interesting. When markets top, stock markets anyway, when stock markets top, they tend to top in extremely volatile conditions. And that's simply because when you've been in a bull trend for a long time and markets roll over and the bears start to think they've got control, the bulls don't give up. The bulls are they don't just say, oh, wow, that's probably the end of the bull market. We'll just stop buying. The bulls will come in and they will buy the dips. They will buy the dips all the way down. You get the biggest up moves in a bear market, would you believe? Now, let me explain that. When markets are falling, they fall very rapidly. Stock markets, when they fall, they tend to fall way more quickly than they go up. They tend to climb steadily. What's the saying goes? Up a ladder and down a slide, or something like that. That's the way stock markets tend to behave. So when they're going down on that slide and they're plummeting, they will hit levels when the buyers will think this is it. It's the low. The stock market's had its crash and we're going to bounce. And buyers will steam in and they will squeeze those shorts brutally, and these markets will have 2, 3, 4, 5, 6, 7, 8% bounces in the days when they move that hard, that much, 6, 7, 8%. Sometimes you'll see these markets rocket, and then of course they'll plummet again because they are in a bear market and the bears will take over. So what I'm saying to you is you will see the biggest up moves, the biggest daily moves, weekly moves to the upside when you're actually in a bear market, and the corrections are brutal. Right, so seeing increased volatility in the stock market can be an early indicator of a topping out. Now, I'm not saying that's happening, but just let's watch that over the next days and weeks to see if volatility does increase. On the weekly chart, we can see that probably better. Are we getting a bit more volatility? Maybe these weekly candles are getting a little bit bigger. Just something to watch. Let's see. Let's now have a look at the S&P. Right, S&P, I warned you about the bearish engulfing candle on the daily chart, which came in on Monday, was it? Yeah, Monday. So this was a warning. I did tell you this is a warning. I didn't say it was necessarily a sell signal. I didn't necessarily say that the market will definitely have a big dump to the downside. I didn't say that this is the top, that's it, the market's over, we're going to collapse. But I did suggest that the bearish engulfing candle would lead to a small correction at least. We're seeing that small correction. Let me show you some levels on the short term. We need to actually put some fib levels on here. I tell you what, let's put them on the daily chart. This is how you're going to have to break this chart down, because you're really going to have to go a long way back if you want to put the fib levels on correctly. How are we doing for time? Yep, I'm going to keep going. Now, the last big swing low was last year. That was the old, that was the start of the coronavirus pandemic. So that's where we're going to take our fibs from. The big swing low down here. Bang. We're going to take it to the big swing high up here, which is where we saw the bearish engulfing candle. Now, how does it look? Do the prices match up nicely with the Fibonacci levels to confirm that these Fibonacci support levels are valid? They do. I think so. Look, 61.8, certainly you've got decent swing highs and swing lows, bang on that 61.8. 50 again, nice. We've got a swing high here, we've got a little swing low here, we've got a big swing low here and a big swing low here. So the 50 is definitely relevant. 38.2, not so much. I have to say we haven't got anything there, but I'm happy with the 23.6% fib. We can take that low from here. So here's what I'm going to do. I'm going to break that down. I'm going to put some more fibs on here so that we can get some more minor levels. I'm going to take that up here to the swing high. Where is it? There it is. And then I'm going to take these fib levels from the 23.6% fib. I would have put some in at the 38.2, but that hasn't worked so well. Now then, what does that give us? Let's blow this up. Gives us a support level around 41.20, 41.15. So we're on that right now. This held yesterday, and we will see if it holds today. I'm just going to get rid of some of these trend lines. That's a little bit confusing. We don't need that one on there. And I don't think we need that one on there either. Have I got that right? Yeah, there we go. Okay, so just trying to clean that up, make it clearer. So watch that 23.6% fib at 41.20. We break below 41.00. That's going to add to further moves to the downside, I would suggest. You can see, look, that 23.6. I love the way that has just come in right where these 1, 2, 3, 4, 5 swing lows are. So it just shows you, and this one, 6, really is a good level, 41.20 in the S&P. Break below 41.00 would clear that, and we should then really be heading down to 40, 60, 40, let's call it 40, 55, 40, 45. That would be the next target for me on the downside for the S&P. Could happen. You know, this support level is holding for now, and it might be a good scalp. You might be able to buy it down there, see 30, 40 points on it. The buyers, as I say, the bulls have not given up. They will be buying on dips, but just be aware, break below 4100, we could be down as far as 40.55, 40.45. That's your next support level for the day in the S&P. And I do think that we are in a correction phase right now, well overdue correction phase. We needed to get this stochastic away from the overbought side and of diverging stochastic. Look at that. So really, look how this, I don't know if you understand divergence, but let me explain it to you. So the stochastic, the slow stochastic, can I put a trend line on there? Maybe not. Let me try it. Okay, no, we can't do that, but it doesn't really matter. You can see, oh, this worked there. I'll have to practice on that and see what I'm doing wrong. Right, you can see now, if I shrink this a little bit so we can see the price action above, and if I do this, and then if I grab it down, there we go. Right, now let's open this up. You see how the price, the S&P, the index, is just continuing higher throughout this period. We've got the stochastic flatlining because it's mega overbought and it can't get more overbought, so it's flatlining. Not a problem. Markets can stay overbought for way longer than you can stay short the market, so, especially in a bull trend. So forget about shorting when markets get overbought in a bull trend. That doesn't work. Believe me, I've tried it many, many years ago. But this is quite interesting. The market dipped a little bit, the stochastic dipped, then the market recovered, the stochastic recovered back up to where it was before. Now, there was a little bit of a dip, but we made a new high, new all-time high. We beat the previous high. So this market has been trending higher. From here to here to here, we've had new higher peaks, and the troughs have been at the same level. They haven't been lower. So we were still in a bull trend. We were still moving higher. But look, the stochastic, the troughs are most definitely significantly lower, and the peaks are significantly lower. That is called divergence. When you see that on a chart, it doesn't happen that often actually. When you see divergence on a chart like this, especially a daily chart, it's telling you that momentum is dramatically slowing, and there is a risk of a correction and move to the downside. And that's what's happening. So when you see that bearish engulfing candle, and you know already that the stochastics are diverging, you say to yourself, hey, there is a risk that this is going to go to the downside. Now, we're not oversold yet on the stochastic. We will get oversold, and then the buyers will come in. And I'm wondering if we have to break 4100 and get down to 40.55, 40.45 for this stochastic to become oversold, and for the market to then find a short-term floor and then maybe rally up. And after that, we could even retest the all-time high at 42.44. And then the question is, do we get a double top? Do we get a big negative candle when we retest it on the daily chart for a double top pattern and then something more significant to the downside? Well, again, I'm speculating and I'm jumping the gun, but it's something we're going to watch over the next few days and weeks, see how this develops. It's more exciting than just up week after week. We might start to get some volatility, and there might be a little bit more of a sort of day trading type opportunity in these stock markets going forward. Okay, running out of time now, I think. So call it a day. Tomorrow's Thursday. Tomorrow's my birthday, actually. So please do join me on my birthday, 7:30 in the morning. It's quite a lot to look at, especially in these stock markets with some quite interesting and patterns developing. Just have a look here at the hourly chart. I just want to show you, before I go away, I've just spotted something else. Look, we've got negative moving average crossover, something you don't often see on stock markets. We've got the 50 crossing below the 100 and the 200. So let's have a look at the 4-hour chart. I think the 4-hour chart would be worth watching if you're looking at this at home, or and see if we get moving average crossovers here as well. Now, this 50 period moving average on the 4-hour chart, the red line, has not been below we haven't had a crossover since 16th of March. So you're talking 2 months since we've had a moving average crossover on this market. We could be about to get one here, 50 about to cross below the 100, and then we'll see what happens going forward, whether the 50 crosses below the 200 and the 100 crosses below the 200. So, you know, a little bit of negativity creeping in from the indicators in the stock market. So these are definitely going to be some fun to follow. As I say, please join me tomorrow morning, 7:30 on Thursday, and we'll run through all these markets again. Good luck today if you're trading. Watch for that CPI number at 7:30 out of the US. There's going to be a lot of I see that number becoming more important in the next few months than the unemployment number, actually. In the old days, back in the 90s, on the trading floors of life, the CPI, there was a time when inflation numbers were more important than unemployment numbers, and I could see that scenario happening again over the next few months. So keep an eye on that today. It will be a market moving number. Right, I've said enough.